Everyone wants the same thing, a low-risk investment that delivers high returns. But there's a problem. In finance, those two things usually hate each other. Imagine two doors. Behind the first door is a government bond paying 4% a year. Boring, predictable, almost nobody brags about it at parties. Behind the second door is the latest can't-miss investment, promising 30%, 50%, even 100% returns. Guess which door attracts the crowd? History shows the same pattern again and again. People chase extraordinary returns and underestimate extraordinary risks. The uncomfortable truth is that the investments creating the most wealth are often the least exciting. Take broad stock market index funds. Over long periods, many major markets have delivered average annual returns of around 8 to 10%. Not every year, sometimes much higher, sometimes painfully lower. But over decades, the math compounds quietly in the background. A $10,000 investment growing at 10% annually becomes more than $67,000 after 20 years. No secret strategy, no trading guru, no midnight crypto panic. Just time doing the heavy lifting. The irony is that investors spend years searching for shortcuts, while compound interest patiently waits in plain sight. So maybe the real question isn't where to find a low-risk, high-return investment. Maybe it's whether we're willing to accept that the most effective strategy often feels too boring to believe.